the Fibonacci retracement scandal. Here it is. Without knowing this, without understanding this, you will lose money. This is the way most people trade it, and most people lose money. So I'm going to give you an alternative way and some extra things that you need in order to make money with it. So let's keep this real short, under 10 minutes. Quick little tutorial. Here we go. Now, when we draw these Fibonacci retracements, we're going to use where we are right now as I record this video. S&P 500 daily chart, great example. We go from this major low to that major high. Okay, let's draw this puppy across there. One of the things that a lot of people don't do, here is tip number 1 for you, is you want to make sure that you've got this level on your Fibonacci. So 0.236. A lot of people don't include that level, and that's a mistake. Look, right here, we went up and we touched that level, and now here we went back and we bounced off of that level. So this level is significant. Now, most people say, oh, this is the only ratio that really matters, and that is the golden mean, and I get it. And if you're a pure Fibonacciist, then, yeah, that's the main level you're going to be looking at. And, yeah, back here, it actually did provide some value. This is another level. We came down to 78.6 now, or 0.786 in this case. So this is another level that not everybody uses, but you want to use it. And the other thing I want to point out is, look, price didn't quite touch the line. All right, this is bonus tip numero dos. That's right, numero dos. That's a combination of French and Spanish. My mother was French, my dad was Spanish, so I combined the languages together. And that's a very important level. But you'll notice that the price didn't come down and touch the line. So second piece of advice here is don't expect the market to go to the exact lines or the exact penny or the exact pip or the exact pixel on your chart. Fibonacci fits into the level of support resistance. That's the category of technical analysis that it fits into. And support resistance levels are zones or areas. So if it gets close to that, then we count it. That's significant. All right, so a couple of extra bonus tips there now. Another bonus tip for you is that Fibonacci is got nothing to do with the mathematics of Fibonacci. What? Wait, did that make any sense, Barry? Yeah, it actually kind of does. So what I mean by that is the Fibonacci levels here, they don't work on the markets, stock market, futures, Forex, crypto, by the way. They are applicable, I'm going to say applicable to all of these markets, but they don't work because they're Fibonacci levels. Now, here's one of the scandals. So the scandal is that the real reason they work is that they are just a self-fulfilling prophecy based on how the average schmo, that's another word for amateur trader, reads the markets and responds to the markets. It has to do with mass psychology. So what happens with the masses, the mass psychology, is when people give back, say, about 25% of their account, or 30% of their account, or 0.5% of their account, or 2/3% of their account, or 0.75% of their account, where they're up by 1/4, 1/3, 1/2. It's these big ratios. These are the ratios, quarters and thirds, and their derivatives, that the average person is thinking about as they're making money or losing money. And it just so happens that those levels are close enough to the Fibonacci ratios. And that's the only reason that Fibonacci seems to, quote unquote, work. But it's also why the markets don't always come right into the line. And again, people aren't getting out at exactly 25% loss or taking exactly a 50% gain, right? As the markets are moving, they're saying, oh, I'm up about 50%. I'm going to take off some profits here. And it could be 47%. It could be 53%. Because the market's always moving and dynamic, by the time the order gets filled, it's somewhere in that zone. And that's really it. Now, somewhere along the line, somebody said, oh, we need to use geometry, we need to use moon phases, and we need to use astrology, and Fibonacci, and all these other things. Let's see if they work with the market, and they just happen to, again, because they're close enough to these big fractions that human beings use. So that's my scandal. Now, one last thing that's very, very important, muy importante, senora, senoritas, in everybody else, is that Fibonacci levels, they by themselves, again, they fit in the category of support resistance, but support resistance in and of itself does not make you a profitable trader. You cannot use it in isolation. So what do we have to use with it? We have to use a couple of things. We have to use trend, first of all, and especially with Fibonacci retracements are meant to be used in a trend. How far is the market going to move against the trend before it continues in the direction of a trend? So trend comes first. Then number two is acceleration. How fast is the market moving? Then number three is volume. We want strength. So what is the volume or the strength or the buying power? So that's all these things. Oh, and then the last one, the fourth one, very important, timing. The timing or cycles in the market. The oscillations of when do we expect a higher or low to be put in? Now, the reason that's important is because, in fact, not only important, but absolutely critical, is because you've got these different levels. So as the market comes down to this level, is that one going to hold? Well, it bounced off a little bit, but then it went right back down to this level. Is that one going to hold? Well, it went up a little bit, but didn't follow through to the upside. And then it came down to this level, right? Gapped right down. And then it came all the way down to this level. And then it finally went careening up. So the question becomes, and this is so important, which of these Fibonacci levels is going to hold before the market then continues back up? Not just a little bounce, but a major move where we can get a big reward. And the answer to that is we need to see strength come into price action. So strength as measured by volume, strength as measured by momentum and acceleration, and the timing of the market cycles. Now, very few people in trading know how to trade cycles. I hardly ever hear people talk about it. So that can be a real edge for you. In fact, it will be a real edge for you if you learn how to trade cycles or timing, because cycles have to do with this lower axis down here. When is the right time to enter the market? So therefore, for all my listeners, watchers, you, I give away my market timing indicator, my market entry indicator, because it tells you the right time to enter the market. So go get the indicator at indicatorwebinar.com. I give a little tutorial there. It's a recorded webinar. You can watch it whenever it's convenient for you. Get the indicator, how to set up your charts, and most importantly, how to trade it.